Welcome to our financial and economic presentation. It was written long before the recent market turmoil, but updated for the crash in March of 2020. This is not financial advice. It is a sharing of research from public sources and my own conclusions. The links to the sources are in the window below, so you can check them out for yourself, for your own research. This is a representation of all the world's money and markets. Let's scroll down the chart. Almost all of what you'll be seeing is a function of debt. Stock markets, shares, real estate, everything. Debt is credit, and we have a credit and debt crisis growing far faster than the economy. They call debt and money production QE, or quantitative easing. It is all the same thing. Half the US economy already goes on paying interest. There are only three things on this chart which are not related to debt. Gold, physical gold, not the ETFs traded on the stock market, silver, again physical, and cryptocurrencies. Let's look at how small they are compared to everything else. The debt is exponential. When it's not repaid, it grows. It adds interest and becomes bigger and bigger, faster and faster. So once it gets to a tipping point, it goes up like a rocket. In 2001, a few billion were used to stimulate the failing US economy. But in 2008, over 5 trillion was needed. The Federal Reserve began intervening in the banking sector last September 2019, and now it's producing new QE or debt at a far higher rate than the height of the 2007 financial crisis. On March the 12th, 2020, the Fed announced an extra 4 trillion to support the markets. That's 4 times the US annual deficit. On Friday the 13th of March, Steve Mnuchin, the US Treasury Secretary, announced unlimited support for corporations. Unlimited. Then zero interest rates were announced on Sunday the 15th of March by the Federal Reserve. These statements are advertising that central banks are going to inflate away unpayable debt, and that the size of the issue is going to be monumental. The problem is that bailout money becomes public debt, a tax burden for the people. And as we've seen from last time, the banks and corporations do exactly what they did before, all over again, after a bailout. The US economy is only being kept going by debt. In fact, we've never seen anything like this in history. The only comparisons are in a few areas which analysts are comparing to the period immediately before the Wall Street crash and Great Depression. This kind of thing can happen for a while, but such imbalances have to collapse because the interest will keep rising. The bond markets will force that to happen eventually, because we should remember that the banks the government bail out are also the banks the government owe money to for the national debt. Stock market crashes are regular, and this is another sign that this one will be big, because it's been put off for 4 years. Every 8 years is how often they happen on average. One of the early indicators, retail store closures in the US, was already 33% more in 2019 than it was in 2008. And there was no obvious crisis in 2019 to most people. Yet, the economy is supposed to be the best ever. So is this true, or is the IMF correct, that there are threats to the whole financial system, including too much corporate debt? Sources broadly agree that 14 to 39% of the S&P 1500, which is the top 1,500 companies in the US, are zombie companies. They can't even service the interest on their debt. It's just adding up, instead of being paid. Now let's consider FANG stocks: Facebook, Apple, Amazon, Netflix and Google. These stocks accounted for 60% of the entire S&P 500 yearly return in 2019. Without FANG stocks, the S&P 500 would have been falling, and it would have been falling for a long time. So the markets are all based on speculation and cheap money pumping the markets artificially to well above historical levels. To check that out for yourself, just look at the stock market as a percentage of GDP chart. We're at epic levels. We have stock markets reliant on technology companies, and technology companies massively overvalued. The price-earnings ratio, which is the price of the share divided by the company profits, means that your Netflix share will take over 80 years of its share of the profits to pay for itself. So what about Amazon? Over 77 years. And Apple, 22 years. And Google, Alphabet, 25 years. Microsoft, 28 years. In practical terms, it means it takes over 80 years of profits to give you any payback on Netflix shares. And that's a major indicator that things are far from normal. Whether your grandchildren will get a profit from your Netflix shares is questionable. Even more importantly, these companies have used their profits for many years in making their share price look good by buying back their own shares. So they've not invested in their future, and worse, they've borrowed money to do it. And it's going to have to be paid back. And interest rates are artificially low, the lowest in fact for over 4,000 years of recorded financial history. So what happens when the interest rates go up? The canaries in the economic coal mine are sending warnings. Retail, cars, look at Ford, transport, which is linked to everything produced, purchasing managers index, order books, airlines, shipping. Airlines are a great example, as we've seen dozens fail in Europe in the last 2 years. 2 of the best 5 years ever for airlines. But looks can be deceptive. The issue is debt. They borrowed so much money, they couldn't pay it back. And crashes are predictable. The problem is they're getting bigger and bigger, and now going exponential. Some industries and indices always act as forewarnings of things to come. Some industries suffer first. Manufacturing, purchasing, transport and copper, for example. And others always take off first as signals of alarm to indicate problems dead ahead, such as gold. And at the same time, the service sector and consumer confidence fall. And then there are the insiders. The top directors of the major companies are already sold out. They've been selling hand over fist at historic levels for the last year, at least. Like GE, General Electric, which recently froze the pensions for their workers. General Electric is a great example. They spent over $50 billion on buying back their shares instead of reinvesting in the company over 20 years or so. And now? The share price is what it was 20 years ago. And they're cutting pensions just to try to survive. Almost all the major companies have been borrowing to buy back their shares. It reduces the number of shares, which makes the share price look better and better, while destroying the PE ratio, the price earnings ratio, which indicates real value. It's a fraud. It artificially boosts the share price, and it's increasing their debt. So what happens when the merry-go-round stops? Let's look at gold and silver since the year 2000. Both of them have outperformed the stock markets for 20 years. Now let's look at Bitcoin for the last 10 years. That has thrashed everything else. Bitcoin is established, but only in the sense that everyone has heard of it. But as the first link showed, all the world's money and markets, it's tiny. It's not deeply financially established, which means there's lots of room for growth. And perhaps we should also note that Bitcoin has been declared dead at least 250 times in the last 10 years, but it's still going. Let's look a little more closely at Bitcoin. The price is in the blue color, but look at the volume bars under the Bitcoin chart. And let's also consider that Bitcoin has a 4-year cycle, 3 years up and 1 down, which is so powerful we can't even see it on the chart for 2014, 15 and 16. So at March 2020, we're only 15 months into a 3-year cycle. Where will it peak this time? No one knows. But we do know, according to the chart patterns, that it will be a lot higher than here. In 2018, 15% of banks and financial institutions actually used blockchain technology. the technology behind Bitcoin and associated cryptocurrencies. In 2019, 84% of them reported that they will be using the technology within the next 18 months. And this is just one reason why the technology has been described as a more important innovation than the internet by Forbes and Bloomberg magazines. Let's now look at the technology adoption cycle. Note where we are in the technology adoption cycle of Bitcoin. Very early. How many people have bank accounts? And how many people own Bitcoin? It's very early. Debt is the real issue. Here's the US national debt clock, but it's only telling part of the story. The US figures are for a total of between $220 trillion and $260 trillion in debt. If we look at the unfunded liabilities at the bottom right, this does not even include banking or corporate debt, which is where those derivatives are. Remember all the world's money and markets? Let's look at the next link for that. So this is at least $220 million. The US population is 329 million. So this is $800,000 for every man, woman and child in the US. Every baby, every retiree, everyone. There are only 6 million millionaires in the US, and 40% of the US population doesn't even have $500 saved for emergencies. So it's time to ask, how is the debt going to be paid? Unfortunately, the answer is easy. It's already been advertised. Governments and central banks are going to inflate away the debt and make their countries and millions of people bankrupt in the process. Because, for them, politically, it's not possible any other way. A key issue is that many very powerful factors are pointing to major problems. Demographics, an ageing population of workers becoming retirees and relying on their pensions, for example, instead of paying tax. Market cycles, the value of currencies, valuations of stocks and shares, and even bonds, which is a far bigger market than the US stock market. They're all in the process of converging. So this is the end game. The places people have invested, houses or the stock markets, which are linked to pensions, are massively overpriced by any historical comparison. They're the most expensive in 4,000 years, because that's how far back the information goes, to the codes of Hammurabi. And here's another issue. This is shadowstats.com, John Williams' Shadow Government Statistics. It shows the real government statistics based on the old measures. I'm not suggesting that our governments could possibly lie to us. It's just that they change the measurements over time. So as we see, using the old official government measures, unemployment rose to above 20% between 2008 and 2010, and it's never been below 20% since, using the old US government measures. Let's look at inflation now. According to the US government, there's virtually no inflation in the US economy. But according to Shadowstats, using the older measurements, it shot up to over 10% in 2008 and 2009. And it remains over 10% today, using the 1980 government measurements. And of course, this implies that the official figures that we're getting aren't real. The dire situation of the banking sector, especially Deutsche Bank, is one issue many are unaware of. It has derivatives exposure equivalent to 8 times EU GDP, 20 times German GDP, at $49 trillion. Think of that as $49,000 billion, or alternatively, $49 million, and you begin to get the picture. It's 49 times the US annual deficit. Derivatives are the bets the banks make, which then become liabilities to be bailed out by the government. Remember the first link, all the world's money and markets, all those bets are many times the value of the whole world economy. The last time this happened, in 2007 and 2008, the banks realised they all owed each other more money than they had, so they ran to the governments to get those debts covered. But the money never existed in the first place, and this process just transfers debt to the people via their governments. It's the equivalent of you, me and a friend all betting each other $1 billion on the future price of a politician. And that's great. We're all looking forward to our $1 billion, which never existed in the first place because I don't have it, do you? And then when the markets crash, we realise we might actually owe the money we bet. So we all run to the government for $1 billion bailout. And the government pays out $3 billion, $1 billion to each of us, that never existed in the first place. It's a good game, but not for the people. It's the people who always get blamed for the debt, but the vast majority of the debt is from banks and corporations. And it's the central banks who are setting the rules of the game. So, the debt has to collapse. It will happen due to cycles, and because we're rapidly approaching a stage where over half the US budget just goes on interest on the previous debt. When the debt is made and grown, as it did exponentially since 2008, it doesn't just have to increase. It must increase exponentially every year. And this is why the debt problem that kicked off the 2007 and 2008 global financial crisis is exponentially bigger today. And in times like these, it absolutely skyrockets. Global debt for every man, woman and child in the world has grown to over $21,000 per person. For a family of 4, this is a family share that totals $86,856. Africans, Chinese and Indians are not going to be able to pay anything near that. So the question becomes, how much can you or your family afford? Can most ordinary people even cover their own share? Are the rich going to be paying it? They never do they? Here's another big hidden issue. The dollar has already lost 94% plus of its value. The pound has lost 99.5%. If exponentially more and more currency and debt is created, it eventually has to create inflation. In fact, the inflation has already happened in most markets, apart from gold, silver and cryptocurrency. Take a look at the stock markets and property prices. Gold, silver and cryptocurrency have been held down because they make fiat currencies look bad. Why? Because they're not associated with debt. There is no counterparty risk with holding gold, silver or cryptocurrency. But this means the lid will fly off when the markets drop and the money runs to safety. Then high street inflation will be unleashed through rapidly escalating retail prices that will lead to a loss of confidence in the money system. The signs are already there, and on average fiat currencies only last 27 years because they've been tried hundreds or thousands of times over history, and the historical failure rate is 100%. This is why next time the bailout won't just be another $5 trillion. It'll be tens or hundreds of trillions. And this will cause a market shock, a massive increase in government debt. The credibility of the system and the money system especially will collapse. And this time central banks can't use their other tool, cutting interest rates. They can only go negative, which will penalise savers. This will cause a loss of confidence. And where will people and major institutions run to safety? It won't be government bonds yielding negatively. It will be a flight to safety to save what they have. If you were a pensioner or multimillionaire, would you be keeping your wealth in a bank, knowing instead of earning interest, you will actually be charged money for doing it? Or possibly even subject to a bail-in like Cyprus, where people's money was taken out of their bank accounts and exchanged for worthless bank shares. And if we go back to where we started and we look at all the world's money and markets, the only places not based on debt are those which do not have markets relying on others to pay: gold, silver and cryptocurrency. If we now consider the size of the markets again, we see that even if a few percent of major hedge funds, pension funds or the world's rich move some of their money into those markets, gold, silver and cryptocurrency, it will be like a swimming pool trying to fit into a teacup. And those items will explode in value, and at the same time, other things will fall off a cliff. If the answer is again QE, more debt and money creation, considering we're diluting the value of dollars, pounds and euros that have already lost massive amounts of value, and the QE debt has to rise exponentially each time, this probably means hyperinflation. Probably deflation first, which is the lowering of asset values in the form of a crash, followed by QE, followed by rampant inflation. So we have two exponential functions coinciding. The loss of value of currency, not from 100% or even 15%, but from under 4% this time in the case of the dollar, and the function of the QE money printing due to debt bailout, as it has to rise exponentially each time. All we need for hyperinflation is for people to lose faith in the money itself, and when it's not even safe in the banks due to negative interest rates and bail-ins, etc., they will spend it on real things to try to preserve value. To put this into proportion, to get rid of the debt of Deutsche Bank alone, it implies creating money worth 20 times the GDP of Germany. And even then, we should consider that the Greeks, Portuguese, Italians, Irish and Spanish, also in the Eurozone, have never recovered from 2008. So most of it is going to be paid by the rest of us through destroying the value of the debt and the value of the money itself. Take a quick look at the following links. IMF chief Georgieva warns of a synchronized slowdown in global growth. The Netherlands Central Bank issues a stunning warning. If the entire system collapses, gold will be needed to start again. That's a central bank talking about the entire system collapsing. They're saying it. And back in October, the Federal Reserve held a secret video conference to plan the launch of QE4. So they knew it was coming. So what kind of crash are we looking at? People like Charles Nenner, the former head of forecasting for Goldman Sachs, is saying that there is likely going to be an 85% drop in the stock market and housing over the next 2 to 4 years. 85%. And so are some of the world's biggest fund managers and many professionals. Gerald Celente of Trends Research. And I think it's important to note that they're professionals because they have a serious reputation to consider. And they're saying it will be far bigger than the Great Depression. I'll share my sources with you so you can choose some and consider the quality of information they offer for yourself. The bottom line is that the Federal Reserve is currently putting hundreds of billions a day into the repo market to keep banks afloat. That's $1 trillion every few days, indefinitely. And to put that into context, the 2008 bailout was only $5 trillion. And the entire US budget deficit is $1 trillion a year. So things have already gone exponential. In fact, Lynette Zhang of ITM Trading says the current repo market bank bail-in, ongoing since last September, is already at $7 trillion. When gold goes up, and in 2019, central banks were already buying more gold than they were in the previous 50 years, it indicates that the big money has already begun to run to safety. Many expect silver to go up more, but there will be a lag. Gold will move first. Many more people can afford an ounce of silver compared to gold, so it's going to be their only option. Perhaps even better, cryptocurrency is more or less infinitely divisible. You can buy $1 worth or 50 cents worth, and it's an even smaller market than gold, a far smaller market than gold. So like Venezuela and Turkey have seen in the last few years, I expect to see a flight to safety there, because there have already been silver shortages last year, 2019, in several countries. You just couldn't get hold of it in Australia, Sweden, and even the US Mint. Now, let's look at what some other cryptocurrencies were doing while Bitcoin hit the headlines in its previous bull cycle. Stellar lumens went up from 0.0002 of a US dollar in January 2017 to 0.86 of a dollar in January 2018. Monero went from $10 in January 2017 to $480 in January 2018. Omi's Go went from 0.53 of a dollar in July 2017 to $27.50 in January 2018. Dogecoin went from 0.0002 of a dollar in January 2017 to 0.016 of a dollar in January 2018. Ethereum went from $10 in January 2017 to $1,335 in January 2018. Ripple went from 0.006 of a dollar in January 2017 to $3.59 in January 2018. It should be noted that the crypto market is very small, very new, and extremely volatile, and most of the coins will not survive. So this is why it's important to get the very best information you can get your hands on. And there are services that provide this, like the Dollar Vigilante, Teeka Tiwari, and Bopolny, because you need to know about which coins to obtain and when to buy and sell them. This is crucial to success. What most people don't realize is that when Bitcoin went up last time, some other cryptocurrencies went up much more. And when we remember all the world's money and markets chart, we can see why. Because if Bitcoin is 60 or even 80% of the overall crypto market, even a top 10 coin could be worth way less than 1% of Bitcoin's value. And if massive institutional money is coming into the market, then if Bitcoin goes up, the other coins could easily go up far more, 100 times or 1,000 times. In fact, the last time altcoin season happened, in 2016, we saw gains like these: 1,790 times, 2,831 times, 3,505 times, 4,144 times, 5,397 times, 7,978 times, 10,018 times, and 20,899 times. That's times, not percent. In percentage terms, it's 289,900%. This time the gains from altcoin season may well be bigger. In fact, they probably will, because it's a function of mathematics. There are many more people involved, more institutions, more big money getting involved. The big money is the smart money, and it moves first. Remember the volume under the Bitcoin chart? The big money tries to find the best value and the biggest returns. So what we're relying on is patterns and mathematics and the technology adoption cycle. Let's now look at what happens in conventional markets. We'll look at Amazon as an example. We'll adjust the chart for the longest yearly timescale and select all. If we look at the shape of the chart goes exponential, but at a rate far slower than cryptocurrencies, which is a much smaller market and much more volatile. The Amazon share price shows what happens when new technology is adopted. It goes exponential due to the technology adoption curve. And given that Forbes and others have said that crypto blockchain technology is going to be bigger than the internet, where do you think the charts for Bitcoin and especially smaller cryptocurrencies are going? At which stage are these tiny fragments of the overall money market now? So it's important to understand that it's better to be in too early than too late. And finally, bear in mind that all assets tend to fall in the immediate aftermath of a crash. This includes gold, silver, and cryptocurrencies. as they'll have to be liquidated by traders to cover their margin calls. They're borrowing on their leveraged trading. But then, after the lag, predictably, they should skyrocket, or even be unavailable in some cases. In all likelihood, there will be a lag after the devaluation, and probably a second lag, as gold will take off first, and then silver. Now, if you're looking for inspirational solutions, I invite you to take a look at Pleasant Quantum Rise. If you enjoyed the presentation, please share it, give it a thumbs up, and subscribe to our channel. Thank you for watching, and good luck.